Good morning. Welcome back to the War Room. I am Malik. Today is Thursday, April 2nd. If you were on the wrong side of the tape yesterday, you did not just lose money, you were mathematically annihilated. On Wednesday morning, we warned you about the market psychology. The entire retail sector and a massive portion of the institutional short sellers were heavily positioned for another cascading bloodbath. Everyone expected the index to collapse toward 140,000. And then, the market makers executed the most violent, face-ripping short squeeze in the history of the PSX. The KSE-100 index exploded upward, completely shattering the heavily reinforced 150K resistance and surging an unbelievable 6,768 points to close the day at 155,511. If you were holding a short position yesterday, your broker forcefully liquidated you to cover the soaring prices. Today, we dissect the anatomy of this historic 6,700-point short squeeze, and I will show you exactly why the corporate boardrooms are still flashing severe systemic warning signs despite the blinding green screens. Let us analyze the pure tape mechanics of Wednesday's 6,768-point monster rally. Look directly at the volume. Over 670 million shares were aggressively traded on the main board. That is pure, unadulterated institutional volume. When the entire market leans too far to one side of the boat, when everyone is shorting the index, the algorithms will inevitably reverse the tape to hunt that liquidity. As the index crossed back over 150,000, millions of automated stop-loss orders from short sellers were triggered. To close a short position, you have to buy the stock back at market price. This forced mechanical buying created a nuclear chain reaction, driving the price higher, triggering even more stop losses, and pushing the index to a massive intraday high of 157,347. Make no mistake, this was not a macroeconomic recovery. This was a targeted execution of over-leveraged bears. The $112 crude oil shock is still entirely real. Corporate margins are still actively compressing. The smart money simply engineered a squeeze to reset the board and generate fresh exit liquidity. The reality of the macro environment is written directly on today's corporate calendar, Thursday, April 2nd. Right now, retail timelines are euphoric, but the absolute epicenters of the macroeconomic kill zone are stepping into emergency board meetings. Mark your screens for the 11 a.m. hour. 11 a.m., Reliance Cotton Spinning Mills Limited, meeting in Lahore to consider matters other than financials. As we have warned repeatedly, the textile sector is suffocating. Despite a 6,700-point market rally, a textile giant is holding an emergency restructuring meeting today. That tells you everything you need to know about the reality of their export margins. 11 a.m., SG Power Limited. Simultaneously, SG Power meets in Karachi for matters other than financials. The energy chain is choking on circular debt and surging global fuel prices. A non-financial mystery meeting here signals severe operational stress. At exactly 11 a.m., the textile and energy sectors are going to provide a massive fundamental reality check for the entire exchange. Here is your battle plan for Thursday. 1. Do not chase the squeeze. A 6,768-point rally is mathematically designed to make you feel extreme FOMO. The institutions want you to buy in at 150K so they can use your capital as exit liquidity for the next leg down. 2. The 11 a.m. crossfire. Watch the tape when Reliance Cotton and SG Power go behind closed doors. If their forward guidance signals distress, the algorithmic sellers will return immediately, completely ignoring yesterday's green momentum. 3. Total cash supremacy. We were sitting safely in cash yesterday. We did not get liquidated in the short squeeze. We survived because we do not play in the chop. Keep your armor on, protect your capital, command the Thursday. Disclaimer. StockSense is an educational platform. I am an analyst, not a financial advisor. The market is facing unprecedented geopolitical volatility. Trade at your own risk.